How's it going today, guys? Welcome back to Stock Radar. Hope you're having a fantastic day. And in this week here, you guys voted on Johnson & Johnson stock for the stock that we cover this week over here in Stock Radar. Now, the timing of this was kind of funny because I just had Ryan, the independent investor, on YouTube stop over at my apartment, and we did a video talking about his top 6 dividend picks. And Johnson & Johnson was one of his favorite stocks and one of the companies he talked about the most. And so if you guys didn't check out that video over on my channel, you're going to want to see that as well. He talks a lot about Johnson & Johnson and why this is one of the stocks that he personally invests in. And so it was kind of funny that we're talking about this stock over here this week. And I think it's definitely a good one to be talking about. And it's one of the first like blue chip stocks we've really talked about. We've covered GE and Boeing. But it's good to be looking at these blue chip companies, and especially one that is a more defensive investment, and make sure that our portfolios are not so tech oriented or, high growth oriented. But anyways, the symbol is JNJ. They trade on the New York Stock Exchange. They have a price to earnings ratio of 23. They have a dividend yield of 2.9%, and this is one of the most amazing parts of Johnson & Johnson. They have a 74-year dividend history. They've been paying dividends for 74 years, and they have a 56-year dividend growth streak. So they've been growing that dividend every single year for 56 years straight. They've made it through all of the financial crises that have happened in that time period, the 2008 financial crisis, and did not have to cut the dividend. They grew that dividend every single year. They have a market capitalization of $329 billion. The type of investment this is, it's a growth and income investment. However, it's more of a conservative growth stock. They're definitely not an aggressive growth company at all. They are a very conservative growth stock and an income investment because they pay a very nice dividend. And they're also what we call a blue chip stock, one of these large, well-established and financially stable companies. They are listed on the Dow Jones Industrial Average, and so they're what we call a blue chip stock, and it's a 132-year-old company. So first of all, let's get a little bit of a background here on Johnson & Johnson and what this company is about. Well, Johnson & Johnson researches, develops, manufactures, and sells healthcare products worldwide. You probably have about a dozen Johnson & Johnson products in your bathroom, whether or not you even know it. 48% of revenues for Johnson & Johnson are international, so it's a company that has great international exposure, and I always like investing in stocks that have great or a large amount of international exposure because you get built-in diversification that way, and you're investing in international markets as a result. And so that's a nice split there, 50% domestic, 50% international pretty much, or I guess 48-52, but pretty close to 50. Now Johnson & Johnson has 3 different operating segments. They have the consumer segment, the pharmaceutical segment, and then the medical devices segment. And the other thing I like about them is they are a Warren Buffett friendly investment. I'm not sure if he is still a shareholder, but he was a shareholder of Johnson & Johnson stock for a long time. And you know how Warren Buffett is with his investing style. He likes to invest in companies that have, a massive moat. He likes to invest in companies that are simple, easy to understand, and he loves those consumer staples. And a lot of the products that Johnson & Johnson produces are definitely what we would call these consumer staples of things we're buying habitually, and we keep them on stock and on hand at all times. So Johnson & Johnson is also one of the largest and most diverse healthcare companies out there. And this was their 2017 revenue mix here. 47% actually came from pharmaceutical, 18% consumer, and 35% from the medical devices segment. And so they are mostly getting their revenue from the pharmaceutical side of the business, but they do have other segments that have healthy demand as well for the products and services they are offering. Okay, so now let's go ahead and take a little bit more of a deep dive into these business segments and what they are actually producing. And first of all, we have the consumer segment. And I want you guys to let me know, just think in your head, how many of these brands do you have in your house, or how many have you heard of? They have Johnson's Baby, they have Listerine, Aveeno, Clean and Clear, Dabao, which that's one I have not heard of, to be honest with you, Johnson's Adult, Neutrogena, Tylenol. I mean, they own Tylenol, that is so huge, Sudafed, Benadryl, Zyrtec, Morton, Pepcid, Stay Free, Carefree, Band-Aid, and Neosporin. I mean, you think of how large Band-Aid is alone. But that's their consumer products. Those are their key products. Under the pharmaceutical business, their largest business, they basically have drugs in the areas of immunology, vaccines, neuroscience, oncology, cardiovascular, metabolic, and more. And under the medical devices segment, they have orthopedic products, general surgery products, sterilization and disinfection products, diabetes care, vision care products, and more. So they are a massively diversified healthcare company with exposure to all these different segments. Okay, so let's go ahead and talk about the pros of investing in Johnson & Johnson stock. And the very first one I want to talk about is the fact that this is, first of all, a low beta stock, makes this a great pick for beginners, being less volatile than the overall market. And this is also a defensive investment. And defensive investments are these companies that see very consistent spending in both a prosperous economy and a poor economy. And you have basically two types of industries out there, cyclical industries and defensive industries. And healthcare is a defensive industry, especially a stock like Johnson & Johnson that's so well diversified. And it really is amazing to me. But we all know how bad that 2008 recession was, and it was the worst crash since the Great Depression. But I want you guys to look at the performance of Johnson & Johnson stock. As you can see, there was barely even a blip in 2008. This stock was very durable during a bear market, and that is primarily why people invest in a stock like Johnson & Johnson, so you don't lose your shirt in a bear market or when we see a correction. This stock had barely even a blip of a correction there in terms of comparing it to what the overall market did. And so this is what we call a defensive investment. Yes, they can be kind of boring in a bull market because the cyclical industries are going to outperform, but in a bear market, people are loving stocks like this because they are a safe haven and they are historically going to have a lot less volatility and downside risk than these other growth stocks and cyclical industries have. Another pro I have for this stock, and this is something that Ryan had mentioned in that video as well, and it's something I haven't really looked at in the past with other companies, but I'm going to start doing this now, is looking at the credit rating this company has. And Johnson & Johnson is one of the only companies out there with a AAA credit rating with Standard & Poor's. And over there on the right, we have the credit rating based on the lettering, and they're different between Moody's and Standard & Poor's. But that is the highest rating that a company can receive in terms of their debt. And it's kind of like your credit score. So you know how we as consumers have a credit score, companies are going to also have a credit rating with the Moody's and Standard & Poor's based on their debt and their ability to pay back that debt and how they think this company is managing their money and their debt load. And so Standard & Poor's gives them a AAA rating, the highest possible score that they can get. So that would be like having the highest possible credit score that you could have as a consumer. And the other thing I like about Johnson & Johnson in particular is that no single product accounts for more than 10% of sales. And so that is absolutely phenomenal to see that they're not relying on any one particular product. It's not like Tylenol is making up 40% of their revenue. Nothing is going to bring in more than 10% of sales. Nothing is accounting for more than 10% of sales. And this is kind of like thinking about the idea of a millionaire having multiple streams of income. You don't want to have all of your money coming from one place, because if that dries up, well, then you're in some trouble. This is kind of like being somebody and you have all kinds of different income streams that are each paying you a little bit of money, and so you're very well diversified in that sense, and it would be very difficult to disrupt you because you have so many different areas you're deriving income from. That's pretty much the situation that Johnson & Johnson is in. Moving on now under the pros here, new biopharmaceutical product launches that Johnson & Johnson has been involved with. And the other thing I like about this stock is it's a way to get low risk and low volatility exposure to the biopharmaceutical industry, which traditionally can be very high risk, high volatility. If you're investing in small cap biotech and biopharmaceutical stocks, you can get exposure to this, but in not such a high risk manner. And so right now they are researching drugs for cancer and stroke prevention, which could be huge areas for their pharmaceutical segment. And they just acquired Actelion. This was an acquisition in 2017, a $30 billion all-cash deal, which significantly beefed up their pharmaceutical segment. And then what I would argue is the biggest pro for this stock is their brand trust, the brand recognition, brand loyalty. And I just grabbed a couple of photos here of their most popular brands, or the ones that I believe people are most familiar with. And you have to really understand that this is a company with such a massive portfolio of brands that people have a massive amount of trust for. They're well recognized and they're very loyal to them. I mean, I can't even begin to imagine how many people are using Listerine every single day, how many people are taking Tylenol every day. These are things people are using every single day. They're the consumer staples, and these are very good investments, especially for, you know, a defensive investment and when you're looking for dividends. That's why this company has been able to pay dividends for as long as they have and grow them as long as they have as well, because there's been very consistent spending for these reasons here. People trust the brands, they recognize them, and they use them habitually. Another pro I have for Johnson & Johnson is the fact that it's a way to capitalize on what we are calling a mega trend. Now, this is something we covered in Growth Investing 101. It's a course in Stock Radar here, so if you guys haven't checked that out, I would recommend going through that. But mega trends are these massive trends that make you say, this changes everything. And there's a mega trend going on now that's emerging, and that is the aging population. So I pulled this article. I think this was from a report called Aging in the United States. The Population Reference Bureau report, Aging in the United States, examines recent trends and disparities among adults ages 65 and older, and how baby boomers born between 1946 and 1964 will reshape America's older population. In 2016, baby boomers will be between ages 52 and 70. Below are key findings from the report, and the most important one, in my opinion, was this right here. The number of Americans ages 65 and older is projected to more than double, from 46 million today to over 98 million by 2060, and the 65 and older age group's share of the total population will rise nearly 24% from 15%. So we're seeing massive growth taking place in basically the oldest part of the population of 65 and older, and these are going to be the people that are going to need more healthcare products, and you know, they're going to be the ones who are buying the Tylenol and all these healthcare consumer products, and also being involved in the pharmaceutical drugs and hospitalization. So the demand for healthcare is going to increase significantly with this aging population, and that is a mega trend that Johnson & Johnson is a part of. Okay, so now let's go ahead and take a look at the valuation here for Johnson & Johnson compared to their peers. They have a couple of different competitors out there. They have Pfizer, Merck, Abbott Laboratories, Medtronic, and then Stryker. And we took a look here at the price to earnings ratio, the forward PE ratio, and then the price to earnings to growth ratio. So first of all, Johnson & Johnson has a PE of 23, a forward PE of 14.2, and a PEG of 2. Pfizer came in the lowest here of the peers with a PE of 19.8, a forward PE of 11.8, and a PEG of 1.9. So Johnson & Johnson is not far off from those figures there. I mean, a very similar PEG ratio, a slightly higher forward PE, and slightly higher PE at today's number. Merck came in relatively high with a 40.2 PE, 13.5 forward, and a 2.2 PEG. Abbott Laboratories came in the highest for the PE. Their current price to earnings ratio is 59.5 with a 19.5 forward PE. However, they have a 19 PEG, which was equally as low as Pfizer. Medtronic came in with a PE of 42.5, forward PE of 15.6, and a PEG of 2.4, having the highest price to earnings to growth ratio, the same as Stryker does as well. And then Stryker came in with the highest forward PE and highest PEG. Their PE is a 34.7 with a 21.5 forward and a 2.4 PEG. So looking at this, this gives you kind of a good idea of which of these healthcare stocks are maybe leaning towards undervalued, and then maybe which ones are more so overvalued. But Johnson & Johnson seems to be at a fair valuation right now, very close to the numbers we're seeing for Pfizer, which is the lowest of these companies that we're comparing here. Okay, so now let's go ahead and move on to the cons of investing in Johnson & Johnson stock. There are not very many, but there are a few worth mentioning. First of all, there are the FDA approval risks that apply to all drug companies, and that is simply the fact that their drugs are riding on FDA approvals, and if they put a massive amount of money into research of a drug that does not get FDA approval, that is pretty much money that is lost for that company. And so they are riding on FDA approval, and so that is one risk there involved with this company. But keep in mind, they have all kinds of other different businesses and ways to derive income. So it's not like investing in a very small biopharmaceutical company. You're investing in a massive company that has the cash to spend on research, and they have other ways to make money. Another thing is pricing pressure and increased government involvement with healthcare companies. Whenever the government is going to get involved with something, you're going to see margins decrease. And so if the government does get more involved with the healthcare process and with health insurance providers, you're going to see the margins for these healthcare provider companies and the ones supplying the drugs and the medical equipment, you're going to start to see their margins start to decline. And then another thing worth mentioning is there's been quite a few past consumer recalls, and that's kind of hurt the brand a little bit. So primarily this was in 2016. Johnson & Johnson's 2016 trial losses included 6 of the 7 largest product defect verdicts. So I'm not really too worried about these product recalls in terms of the amount of money they're spending on this and also the lawsuits. More so I'm worried about the brand recognition here, and it kind of has hurt Johnson & Johnson in the short term just with these things hitting the headlines and people hearing about that and associating that with the name, but really it's not that big of a deal. It's just something that was worth mentioning. So moving on now, let's go ahead and talk about the barriers to entry that Johnson & Johnson has, or what isolates them from the competition. Number one, the biggest piece for me is the brand loyalty. Like we said, Johnson & Johnson has so many different brands under their name that are well recognized that people have a massive amount of trust in. Number two, the government regulation involved with the healthcare industry is going to really discourage people from entering this space. Number three, they have a massive amount of medical patents that protect them. Number four, having a diverse product portfolio helps them out as well. And then number five, simply the economies of scale. When they're selling products at a certain volume, they are able to sell them at a cheaper price. And if you were going to go out there and start making bandages, it would be hard for you to be price competitive with Johnson & Johnson when they're able to produce at such a massive volume. Okay, so that wraps up the beginning of our analysis. Now let's go ahead and jump over and take a look at the fundamentals. And this was another one of those stocks where I was unable to get the balance sheet and other financial documents from NASDAQ. I pulled this from Morningstar, and so it's a bit of a different look than you guys might be used to. First of all, asset growth was flat from 2013 to 2015, but it picked up in the last 2 years in 2016 and 2017. Total assets grew 5.8% from 2015 to 2016 and 11.4% from 2016 to 2017. So we're not seeing any kind of massive growth here with the total assets, but they are starting to show signs of some growth going forward. And then cash and cash equivalents have been steady, and the cash pile was depleted in 2017 due to the Actelion all-cash deal. That was a $30 billion acquisition of that pharmaceutical company. Now this is where we start to see some things that I'm not really a fan of here looking at the liabilities. Total liabilities were relatively flat from 2013 to 2015. We saw 6.2% growth over those 2 years. However, total liabilities grew 13.7% from 2015 to 2016 compared to 5.8% growth in total assets. And total liabilities grew 37.2% from 2016 to 2017 compared to 11.4% growth in total assets. So total liabilities have significantly outpaced the growth of total assets, and long-term debt is on the rise as well. Now, current assets have adequate coverage of current liabilities at a ratio of 1.4 to 1 in 2017, and I like to see 1.5 or higher. 2 to 1 is fantastic. And then total assets have adequate coverage of total liabilities as well, 1.6 to 1 in 2017. So debt growth has significantly outpaced asset growth in the last 2 years. But the one thing we have to remember here is that Johnson & Johnson does have a AAA credit rating, and so I don't think the debt load is a problem for this company. It's just something that you want to pay attention to going forward as an investor. Moving on now, let's go ahead and take a look at the revenue here. So total revenue has been relatively consistent over the last 5 years. We saw total revenue grew 2.6% from 2015 to 2016 and 6.3% from 2016 to 2017. And so what we can gather looking at this, and if you look at the revenue over the last 5 years, the spending for this defensive industry is very consistent. You're not going to all of a sudden hear that the sales of Band-Aids, increased 100%. People are going to buy about the same amount of those as they're buying, just as they need them, and the same thing for their other consumer healthcare products. So you're not really going to see massive growth here with this company, but what you are going to see is consistency. And if you are a dividend or income investor, that's what you're looking for. You want to find a boring, consistent company to invest in, and Johnson & Johnson certainly fits the bill for that. Cash flow from operations did increase 12.3% from 2016 to 2017 as well. So now on to the performance of the actual stock. Johnson & Johnson stock is down 8.7% over the last year compared to a 16.8% return from the Dow Jones Industrial Average, and they are a component of that index. and Johnson & Johnson stock is up 46% over the last 5 years compared to a 68.6% return from the Dow Jones Industrial Average. So Johnson & Johnson stock has underperformed the index that it is a part of. But again, this is what you see happen with these defensive industries in a bull market. Defensive stocks are more durable in a bear market, but they tend to underperform in a bull. That's exactly what we're seeing happen. The dividend is about as safe as it gets with income investments out there. So if you're looking at them from an income standpoint, you would love a stock like Johnson & Johnson. And basically this low beta stock is an excellent pick for beginners. However, investors looking for growth will likely be looking elsewhere. If you're an income investor and you want some growth of the underlying asset, then Johnson & Johnson is a perfect pick for you. If you're a beginner and you're just looking to get started, again, this could be a great pick for you. But if you're looking to have some aggressive stocks in your portfolio, some high growth stocks, Johnson & Johnson is not going to do it. But the one thing I do want to say is keep in mind how this stock performed back in during the 2008 stock crash. It was a lot less of a drop than we saw with other stocks out there. And so that is, again, why people invest in stocks like Johnson & Johnson, because of the durability. And then finally, we're going to go ahead and wrap up with some first quarter 2018 financial highlights from their most recent earnings report. As you can see, their total sales came in at $20 billion compared to $17.8 billion in that quarter a year prior. GAAP earnings were the same at $4.40. GAAP earnings per share came in 1 cent lower at $1.60 versus $1.61. Again, this just screams consistency to me. Adjusted earnings came in at $5.60 compared to $5, so an 11.8% increase there. And adjusted earnings per share came in at $2.06 compared to $1.83, a 12.6% increase. But anyways, guys, that's going to wrap up this analysis. Thank you so much for watching, and I will see you in the next video.